Markets have had quite the run so far in 2025, with the S&P 500 up around 13% year to date, the TSX up around 20%, and not to mention gold hitting another record high. But we are in an environment of uncertainty, with the Fed cutting rates for the first time in more than a year, sticky inflation, and ongoing trade tensions. So as the fourth quarter quickly approaches, where do we go from here? Michael Craig is Managing Director and Head of Asset Allocation and Derivatives with TD Asset Management, and he joins me now. How are you?
Great, Kim, how are you?
I am well. So what do you think when you look at these markets right now?
We're bullish. Yeah, we're bullish. I mean, the rate of change has been a bit quicker than usual in the last year, but if you look over like a 5-year basis, markets are up, low single digits. But I think they're reflective of, I think, a new reality that we're in, and that reality is one that we're going to have materially higher nominal GDP growth, which will mean higher revenues and ultimately better earnings. And so I think the market's correct to be bullish. Most investors are not. It's pretty balanced in terms of bulls versus bears right now. But we're, for a variety of reasons, we think that markets are going to continue to power forward. At least over the medium term, without, you always might get a pullback here and there, but we kind of see a pretty sanguine environment to earn a return right now.
We'll get into it, and I should let people know that we've got the Wealth Asset Allocation Committee recommendations coming up very shortly. But I have to ask, we do have rate cuts, or have come, I should say, from the Fed, Bank of Canada, seeing some weakening in the labor market, but those are not the things that or I should say the rate cuts are positive for equities, but how do you net that all out?
So empirically, anytime you have a cutting cycle absent of recession, it's bullish. We don't think we're going to see a recession, but we do think that you're going to see, within Canada maybe a few cuts, but in the US a material cutting cycle, and that will be very accretive to growth. There has been this kind of rolling recession throughout various industries over the last few years, so it hasn't brought down overall growth, but it has been painful. As you get a kind of looser monetary policy, those industries should start to fire. Any type of industry that's interest rate sensitive will get some relief. So with that backdrop, you've got cutting cycle, you've got NATO pledging to spend 5% of GDP, like that. Markets kind of forgot about it, but it's like $1.7 trillion of additional spend.
It's a lot to remember, right?
It's a lot of money. You've got various governments around the world pledging capital for major growth initiatives. This is a pretty impressive backdrop for growth. At some point, you might have some inflation, but I don't see that as a near-term risk. So, stepping back and not to get overly complicated, it sets up for a pretty good market.
Just to double down what you were saying, like seeing rate cuts when there's not a recession, so non-recessionary rate cuts. You're saying just historically, that's always been very positive.
Sure, yeah, absolutely. Again, we're in a slow patch.
Yep.
Growth recently has been a bit weak. Tariffs are still starting to hit. But I would expect that we would expect to see some reacceleration, particularly with all the announcements about spending and with the precautionary. And policy is probably too tight in the US right now, so that's going to release, again, pent-up demand for risk assets.
What about a lot of talk, I know with some of your colleagues I've talked about about Fed independence, and just to bring that back to the US growth, maybe a weakening US dollar, and some of the reasons why you might see some of this weakening US dollar being what's happening with the Fed. What's your take? What do you think is going to be the impact on that?
I think that there is a way it's being spun, and then I think there's reality. The reality is that the Fed hasn't done a fantastic job last few years. The Fed has been very much beholden to its internal models, and that's the kind of the approach they've taken. That's not the way Greenspan ran it. The U.S. economy was doing quite well, and he wasn't cranking up rates back through the 1990s and 2000s. And I think that you are going to see, a shift in the Fed composition, particularly over the next 10 months. And therefore, are they going to have more fractious debate? Possibly. But I don't feel that this is the end of the Fed. So be it. It's just the Fed is a construct of Congress. We have as a society given a lot of power to non-elected officials. Globally, that's starting to shift somewhat, including Canada. And I think you're going to have a bit more thinkers in the Fed who are kind of looking at kind of what may or may not happen versus being beholden to what a model tells you. And because those models tend to, economics is not a pure science.
Yeah.
We're not splitting
Nor
atoms.
is it a static science.
It's an open system, and it
Yeah.
changes. And we didn't have AI 10 years ago, so you got to be careful about using what we used 10 years ago today. So I just think there's going to be a much more colorful debate. It will create some volatility in markets as the market tries to absorb this. But the end game, and that's where we come in, is I think we're just going to have looser policy, and we probably should. So I don't worry about the end of the Fed, but I do think that we're going to see a shift of decision-making rights back to elected officials. You might not like that elected official, but that's democracy and that's how it works. And I think this is part of that process.
How does that net out from a currency standpoint then for the U.S.?
Well, certainly to get the rebalancing that the U.S. is looking to achieve, and really that rebalancing is to move away from a consumer-driven economy to a production-based economy. A weaker currency would be very accretive to getting that to happen. I think it's kind of a gradual decline over the next few years. The market sometimes overshoots, so take my words with a grain of salt because currency markets can be quite violent. But we would expect to see a weaker dollar in the years to come. Will be a headwind to U.S. assets. I still think U.S. assets do fine. The S&P generates 40% of its revenues offshore, so there's a bit of a natural offset. But Canadians have gotten really gotten used to this great returns in local currency because of the weakening of the dollar, Canadian dollar. I think that's over, and I would expect
that's big. I think that's worth almost
massive.
pausing for Canada. That's
Huge.
a big deal.
It's added a ton of return to investors' portfolios. And if you look at the balance of investments, everyone is skewed to the U.S. The world is skewed to the U.S. And I think we're going to go through a natural rebalancing phase over the next couple of years. It's why I'm quite excited, because there's more things to do than just buy the U.S. market. I think there's a lot of different opportunities, both in Canada and globally, that makes a lot of sense in a portfolio. So I would say it's probably close to one of our top risks in terms of a weakening U.S. dollar. And it's a question of how do you manage it within a total portfolio. And again, it's not a call to sell U.S. equities. I think that's actually accretive to U.S. equities, but there are areas where we will use hedging strategies to offset that decline.
Yeah, something you have to pay attention to where you didn't before.
100%.
I want to turn our attention now to allocation and what the Wealth Asset Allocation Committee is recommending. So let's start with equities.
Canadian markets had a great year for a variety of reasons. So still like those two markets. Outside of North America, I think it makes sense to start looking at these. Canadians generally have a very, unless they're invested with my team, generally have a lower exposure to global stocks. So it is an area that I think bears some watching more so than past years as, again, capital flows start to shift and countries start to really focus. Well, if I don't have pure access to the U.S. market, I have to really focus on my domestic economy and my domestic demand, which leads to investment around the world. So I do think that it is, getting more and more we're looking at more in global exposure. But yeah, overall overweight equities, and it's been a good place to be this year.
And fixed, underweight?
Yeah, I mean, you got to fund it with something. Fixed income, I was just looking at returns the other day, and so like 22, horrible year. 23, 24, 5%. This year, we're kind of coming in maybe give or take 4 or 5%. So you're still getting income, and you do have a cutting cycle ahead of you. On Canada, I do think you got to be careful about the budget. My sense is that you're going to see a pretty big fiscal deficit coming through. It might just kind of be a one-time, but that means more issuance in the longer end of the curve. And so you might see longer rates drift higher, which would be not helpful to prices. And that would be true for various jurisdictions where, Germany looking at getting to 5% of GDP and defense by 2029, they're going to have to raise money. So ironically, the U.S. market, interest rate market, currency hedge might be one of the more attractive places to be, because I actually think U.S. rates are going to go lower relative to other jurisdictions. So in fixed income, underweight, still like credit. Spreads have become quite rich, but corporate balance sheets are quite solid. And we would expect to see continued tightening of spreads, which would be accretive to prices over the next little while. But next to equity, I think equities are a superior investment right now.
We have alts and commodities. I'm going to go to commodities actually next. Where are you commodities?
Neutral within the alts complex. Again, we've invested in commodities by selling fixed income. That's been a correct decision this year, and it really is that ingredient that will protect clients if we get into an environment of inflation becoming a bit more ornery. It is the ultimate, our work would show it is the most sensitive asset class in a positive way to unanticipated inflation. And so we're neutral right now. I don't expect that to happen next month, but certainly on the investment horizon, as you start to see spending increase, that puts pressures on supply and could lead to some. I expect to see more inflation volatility in the years to come, and therefore that's where commodities has its place.
And alts.
So overall, overweight infrastructure. We love commercial mortgages within the fixed income exposures. Within the equity exposures, we love infrastructure. Real estate is starting to turn the corner. It's been a tough few years for real estate investing. It feels like much of the bad news is priced through. So the asset class is stabilizing. There has been some headlines of other firms that have gotten into some trouble. But we continue to see opportunities in that kind of higher quality slice of the market, tier one office space, for example, where everyone wants to work. And as more and more people go back to work, this is going to increase demand for it. So again, it's an area that I think is through it's had a tough go. Returns have been de minimis, but I would expect to see stronger returns years ahead. That being said, it's not an overweight right now.
I always like asking you this question because I don't know what you're going to say, but what have we not talked about that we should? Like what's on your mind or what's on your radar?
So we talked about the budget in Canada. That's a big one. I think that, I guess one thing would be, there's a lot of noise right now. And I worry sometimes that people's view of reality of the world is shaping their investment decisions. And you kind of have to separate them.
Can you give me an example of that?
What's happened in the U.S., it's all going down. I want to sell all my U.S. equities. Well, that's not. The U.S. is always the U.S. goes through periods where it's quite fractious and divisive, and that is happening, and so be it. But you got to look at the companies there, which actually are doing phenomenal.
Yeah.
And I just think that as investors, you have to be very
clinical,
yeah, and not get too worked up in the headlines of the day. And I'm not saying the headlines of the day aren't upsetting. But we are living in a fantastic time. We're all living longer. Life is good, broadly speaking. Poverty rates are at all-time lows. But we always focus on the negatives, and there are negatives. And I just think that sometimes that leads people to be underinvested or pull back, or I'm going to put it off for another day. And you get these periods where you're shrinking your working years because you're going to be able to retire sooner if you're able to participate in these types of markets. And so one thing I would just say, and I get the question a lot, where I get these pushbacks, and I struggle a little bit because we look at it our way, which isn't the right way for everyone, and it's right. That's right. People are watching the news and they're seeing what's happening, and they're afraid. I just think we get overloaded with information sometimes, and I like to keep it simple. And I think that's one area where we haven't talked about is just trying to be invested and working towards that goal of building your nest egg.